Jeremy Schwartz, it's been a rough start to trading here in 2015. The S&P is down over 2% so far this year, had high volatility. So is the United States still a good place for people to put their money or not?
You know, when you talk about the high volatility, I mean, it reminds you of the reasons I really like to look at the dividend trends of the market. And the dividend trends are really comforting, I think, to investors. When you look at the last 3 to 5 years, we've had 5 consecutive years of double-digit growth. And in this last year, companies are indicated that they're going to grow the dividends about 12% of 2015. So I think the trends in dividends are supporting the market. The valuations are reasonable on a dividend when you look at the growth trends. So I think the markets are sort of fairly valued. They're not as cheap as they were a few years ago because we've had such strong gains, but they're not super expensive when you factor in the dividends and buybacks all the companies are doing.
What about putting your money in Europe? The euro is now, it's $1.17 per euro, which is where it was in 1999 when they launched the euro. So this should be good news for European companies. Do you want to buy into Europe now?
You know, when you think about what you just talked about, the euro, 12 months ago, there was around 140. It's trended back down below 120. A lot of people think there's more volatility in the euro to come. And I think the biggest question is when you're looking at the European stocks is, do you want that euro exposure? I really think it's important to be hedging your euro because there's a lot of uncertainty. I don't think there's value to adding the euro over time. There is a lot of uncertainty about where it's going to go. And so if you think about the weakness that the euro has, it could be helping their exporters. So I'd be focusing on the exporters that benefit from the euro, but also very critically to be hedging it, as we do in one of our strategies, HEDJ.
And you also have the DXJ, which is your hedged Japan fund. The yen is now, it's 116 yen per dollar. So is it a good time to get into Japan? Because Japanese stocks really have been falling since mid-December. It's been a sharp downturn.
I mean, Japan is still one of my favorite markets. If you think, you know, how much of the yen has gone in just the last 2 years. November 2012, when Abe came into power, it was 80 yen to the dollar. Now it's, like you said, 116. It's moved a lot. So you certainly talked about you wanting to hedge the yen if you're going to get exposure to the Japanese stocks. But I still think from a portfolio flows perspective, what the Japanese are doing from the Bank of Japan, their biggest pension fund, the GPIF, is a $1.1 trillion pension fund, the largest in the world, is shifting their allocations from 60% bonds and increasing their equities, increasing their foreign equities, increasing their foreign bonds. There's a lot of money in motion in Japan, and that's going to be supporting their equities. You don't want to say there's a full put underneath the market, but they are buying stocks, and that's going to cause other pension funds to increase their allocations. And so again, I'd want to hedge the yen. I think the Fed's going to be raising rates at some point. They're going to be keeping their pedal to the metal on supporting their economy with monetary policy accommodation. But valuations are 25–30% cheaper than the US market when I look at Japanese exporters again. So I'd stay focused on Japan as one of the best places in the developed world if you're hedging the yen.
And then finally, what about China? Copper fell off a cliff in terms of prices. They were a huge buyer of copper. This has unnerved a lot of people because people watch Dr. Copper. What about emerging markets, especially China?
You know, China has, I think, the key lever for a lot of emerging markets because the parts that have sold off the most, countries like Russia and Brazil, are very commodity-centric, and they're slowing down partly because China's infrastructure-led boom is slowing down. They're going more to an internal consumption model and less to this sort of heavy commodities buying. But you know, if you say what are the two most out of favor, cheapest part of the markets, is Chinese financials, sort of Russian energy companies are the two cheapest parts of the global markets today. So if you're looking as a contrarian investor, where is there real deep value? Those are the two. And you just got to feel a little bit better about China's growth. Is it not falling off a cliff? Are they going to keep managing their economy and not have a real hard landing? If you believe that, I think emerging markets in China, those two places in particular, are interesting places to look.
All right, thanks a lot, Jeremy.
Thanks, Greg.
And thank you for watching The Street.